The S&P 500 currently trades at a ratio of 30.8, which is very high, and why in today's episode we're focusing on 3 ridiculously cheap AI stocks to buy. Now each one massive upside, nice margin of safety. We'll jump straight in. We have Qualcomm stock here, which is up around 23% over the last 12 months. Over the last 10 years, it is, however, up around 114, marginal underperformance to the S&P, and we can see all-time highs this year around $230. We get a double buy rating, seeking alpha Wall Street, a hold from Quant, and we do notice it is quite some way away now from the 52-week high. In fact, trading towards its 52-week lows with a forward yield of 2.2% and a forward P of around 14.02. Now, the great thing to note is we see green right across the board. What this means is that over the next 4 quarters, they are anticipating growth each one to the EPS year on year. And over the last 4 quarters, they have outperformed each one, 100% track record, nice historical forecasting accuracy from management. And if they do hit that EPS estimate over the next 4-year accounts, 12.4, which maybe we do have faith given their track record, that will lower the forward PE even further to 12.67. We then move on to the metrics where they have a dividend safety score of 80. We'll cover these 2 valuation processes, and nice to see an above inflationary increase of the dividend, 6.3% in March this year. Remember, ideally we want a minimum of 4 just to keep up in line with inflation. And we notice here last week it was reaffirmed dividend safety score is 80, meaning that a dividend cut for Qualcomm is unlikely. Now, key metrics reflecting on their performance in the 07-09 crash, they increased the dividend, they had above average growth, -7%, S&P was -12, and they massively outperformed in terms of return, -21, the S&P itself, -55. In terms of dividend growth, we already mentioned attractive in March this year, 6% over the last 5, but historically they have been increasing that dividend at a very attractive rate, 15% year on year over the last 20, with 21 years of consecutively increasing that dividend, meaning they are 4 years away from becoming a dividend aristocrat. Then we get into the first valuation model today where we get that undervaluation signal. Now bear in mind we don't conclude on any of these, we're not looking at them in isolation. The blue tunnel is that expected fair price. Right now, for the first time I believe over the last year, it is below even the bottom end of the blue tunnel, indicating severe undervaluation. We then move on to dividend yield theory. Remember, this tells us that a company is undervalued if the current yield sits above the 5-year average. Right now, we see it in line. This would be a reasonable signal. However, the forward P telling us a different story. 14 below the 5-year average of 15.8. That is an undervaluation signal. And interesting to note, it trades at a massive discount to the overall information technology sector of 26.4. In terms of the first metric we're going to see today, it is the free cash flow payout. Remember, on this channel, free cash flow over the earnings, which is susceptible to manipulation by management through accounting, below 50% for the semiconductor space. Reason why we have these targets, we want faith management can increase dividends at a very attractive rate. And nice to see over the last 4 years, including the trailing 12-month and anticipated over the next 12, the 3 cash flow payout is below that maximum threshold we want to see. We then move on to the free cash flow per share, where we want to see consistent increases over the longer term. Whilst we don't get them consistently, we do note, in fact, a 4 times increase or thereabouts over the last 10 years. And even though an increase is expected over the next 12 months, it is only marginal to around $10.40 per share. We then move on to sales growth. Now remember, cyclicality will show up in these numbers given the industry they operate in, and that is shown given 5 of the last 10 years have been negative. Nice to see though, 2024, 9% growth to their top line revenue. And when we do zoom out and look at the numbers, we can see, yes, inconsistent, nonetheless, top line has been moving in the right direction. Now we draw your attention to the shares outstanding, where we want to identify companies that return excess cash to investor pockets through those share buyback. Conclusion is here that they have done that, but very inconsistently. In fact, over the last 5 years, it has barely moved. So we do anticipate this isn't part of management's capital allocation for the time being. Then we get to the ROIC, 10% or more, or 12 for the industry. Give us faith, management can effectively allocate their capital. looking very strong, yes, inconsistent, but pretty much above the minimum every single year. 25% in 2024 and on a trailing 12 month is very attractive to note. And then we get to the operating margin, where we want to see not just above the 16% minimum for the industry, which we get every year, but operating efficiency, not something we note from Qualcomm as of yet, but that is when the margins increase over the longer term, and that is typically our high quality identifier, revenues increasing as well as the margin. No issues whatsoever with the free cash flow, well above the minimum, 29% on a trailing 12 month, very, very attractive, not just for potential investors, but those who currently hold this in their portfolio. Then we move on to the final metric, net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Below 1.5 is what we want to see. That is what we get. And the numbers below reference the number of years it would take the company to pay off all of their debt net of cash on hand. Remember why we focus on this metric. It correlates to dividend safety, balance sheet strength. The fact it has decreased from the highs around 2018, 2019 is a great sign of management looking to de-lever the balance sheet. 0.41 on a trailing 12 month, there or thereabouts over the next 12, so we can see dividend is safe and balance sheet does look strong for Qualcomm stock. Now let's jump into the valuation process. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now when we do our deeper dives on this channel, we do run through every single one of these models, talking about the inputs and outputs. Today, let's get straight to it. The intrinsic value of 220 is the average of these four, and we always like to do a margin of safety, starting off at 10%, executing on that if it meets our three golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that, we'll buy at 198 in today's episode, then we keep going till it's near the current trading price to understand what margin of safety we're playing with today. And for Qualcomm, we believe a 30% MOS with Wall Street very bullish. They see $205 price target over the next year. They see upside of 32%. 30% MOS, 32% upside. Give us your thoughts below. Is this one you are buying, maybe just holding, or in fact, for whatever reason, you are looking to sell? We also want to let you know we have released our latest free weekly article where we talk about two beaten down stocks with over 30% upside. You can grab a copy by clicking on the pinned comment below, and we typically drop one to your inbox every single Monday morning for free, where we highlight severely undervalued stocks and what's gone in the market over the last few days. You will also be able to grab a copy of 40 undervalued stocks for the month of November. Lots of information for each one, the upside that Wall Street themselves see over the next year, and also a recently released spreadsheet looking at 29 undervalued dividend stocks that Wall Street themselves believe have the most upside right now in the S&P. So click below, you can sign up and start reading straight away. The next stock we're covering is Lam Research with a double buy rating and a hold from Quant. Again, similarly to Qualcomm, trading towards its 52-week lows, a forward yield of 1.27%, a forward PE at 20.4, and over the last year, performance has been flat. Over the last 10 years, unlike Qualcomm, has massively outperformed the S&P, up 772%. Also bear in mind though, this doesn't include dividends reinvested, so if you have been reinvesting, your position would be up higher over the last 10. Again, green right across the board. We'd love to see that. In fact, the next 4 quarters, they anticipate double-digit growth every single one, with a nice 100% outperformance over the last 4. Now, June 2026, their next full year accounts, growth is expected to the EPS, there in turn lowering the forward P to 17.2. We get another safe score in the dividend at 66, with an incredibly juicy increase to the dividend at 15% in August this year. In terms of key metrics, well, last recession they did not pay a dividend, so we have no comparable data. However, what we do note is they had below average growth in terms of sales, negative 55%, whilst also marginally trailing the S&P with their negative 64% return. Dividend growth, well, they serve that here in high quantities, 15% in August, 13% over the last 5, 46% over the last 10 on average year on year, whilst increasing the dividend for the last 10 years on a consecutive basis. Then we get to the valuation, where we can see over the last 12 months, it has recently entered into the fair value space, right now sitting right at the lower end, indicating slight undervaluation. We then take a look at dividend yield theory, where we can also notice slight undervaluation with the yield at 1.27 above the rolling 1.17 and the forward PE pretty much in line. In terms of comparing it though, very similar to Qualcomm, Lam Research is trading at a discount to the information technology sector as a whole at 26.4. In terms of free cash flow payout, below 50% every single year, 22 on a trailing 12 month. So we will expect these double-digit increases to continue from Lam Research. And we also notice very, very strong growth over the last 10 years. Yes, a little bit of inconsistency here and there. And over the next 12 months, a small increase is anticipated to 337. As we did see with Qualcomm, although they did have more negative years, Lam Research have 2 out of the last 10. However, unlike Qualcomm, 2024 has been a negative year for this company. So when we do zoom out, we still notice 3 times increase over the last 10 years, 5 billion to 15. And we can also see they have been doing share buybacks, in fact buying back quite a significant amount over the last 10, 1.77 billion, now sitting at 1.31. In terms of ROIC, no complaints whatsoever, again well above the minimum 12%, especially in the more recent period, 34% just on a trailing 12 month. And then we get to margins. We do notice here some small efficiencies over the last 10 years, 17% in 2015, 29 on a trailing 12 month, and no worries whatsoever on that free cash flow, 5% year on year, well above 31 again on a trailing 12 month basis. Net debt to EBITDA looking very strong, 0 in 2024, 0 on a trailing 12 month, 0 anticipated over the next 12. This indicates to us it won't even take them one day to pay off all of their debt net of cash on hand, something we love to see. Intrinsically, our value $98, bang on where Wall Street see this at 36% upside. And then when we do get to the MOS and we see in today what we're playing with, for Lam Research, pretty much up to $73, 25% MOS, 36% upside, similar to Qualcomm, looking very, very attractive in what could be argued as an overly inflated market. Don't forget, give us your thoughts below. And you can also grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for Lam Research or any others that you do desire. We then move on to ASML holding with a double buy again, and that hold from Quant, trading at its 52-week low, a forward yield bang on 1%, a forward P at 33. Over the last 12 months, pretty much flat, down around 2%. Over the last 10 years, similar to Lam Research, massive outperformance, up 522%. This one, as we can see, is significantly lower than the 52-week high of $1,110. Similar to Lam Research, double digit is anticipated over the next 4 quarters, and we can see outperformed over the last 4. In fact, all 3 stocks today, Qualcomm, Lam Research, and ASML, all we saw green right across the board. EPS is anticipated to increase by around 20% over the next full year, and that in turn will lower the forward P to 27.25. We get our first very safe dividend score at 82, yield of 1% as we said, undervaluation notice, and an inflationary increase to the dividend in July this year. Now, dividend safety score was reaffirmed in October the 30th, and what very safe means is that a dividend cut is highly unlikely. Last recession though, ASML did cut the dividend, they didn't maintain it or increase it. They had below average growth significantly at negative 56, but they also had an inline S&P return negative 55. Now, shareholders probably disappointed with the increase this year, given the last 5 and the last 10 years, they have been growing them at a very rapid rate, and we can also spot 14 years of consecutively increasing the dividend. Then we talk about the first valuation based on the forward P, and what we notice over the last 12 months, more so just over the last few weeks, this company has entered severe undervaluation territory. This is also highlighted when we look at dividend yield theory as well as the forward P, yield above the 5-year, forward P below the 5-year rolling, although we do notice it does sit marginally higher than information technology, so trading at a small premium to that market. In terms of the payout ratio, we do notice 74% in 2023, probably why we did get that subpar increase. Nice to see over the next 12 months, anticipated to come down to 13%, so we should expect a lot more attractive increases. In terms of the free cash flow growth, very inconsistent, in fact peaked in 2021, came down the subsequent 2 years, however good to see massive growth anticipated over the next 12. In terms of sales growth, well, every year has been an increase, unlike the majority in this cyclical industry, although we do note on a trailing 12-month, we can start to see some weakness in 2024 for ASML. However, when you do zoom out, the top line has been increasing at a very, very strong rate, and they've also been doing share buybacks, buying back around 10% of those shares that were outstanding in 2014. ROIC also looking very good, especially over the last 3 years, and even the 38% on a trailing 12-month is still very attractive to note. We can see some small signs of operating efficiency, 26% to 33% in 2023, and the free cash flow, whilst inconsistent like the majority of those stocks in the industry, still looking very good, 11% on the trailing 12-month. Probably the best metric for this company is that net debt to EBITDA, just the consistency around the zero over the last 10 years, over the next 12 months, won't even take them one day to pay off all of their debt net of cash on hand. Now our intrinsic value today is coming at over $1,000. We will show you how we got this because we are using the DCF model. Essentially, we have the free cash flow growth year on year. The average growth over the last 10 years has been 35% year over year. Now forwards looking, we've gone for 20%. As you can see though, we have a low, medium and high. With a discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, 1128 indicating 70% upside from the current share price. Now remember, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for ASML or any others. But for transparency, we'll show you at 15%, $834, indicating 25% upside, and at 25%, for those that are a lot more optimistic, 1517, indicating more than a double from the current price at 128. We are going to take through the medium rate today at 20%. As we said, we do like the MOS, and at the 10% mark, a buy at 1015. This one in today's episode does have a significant margin of safety. In fact, you're looking at least 40% up to 677, not quite at the 45% level just yet. So with a 40% MOS, Wall Street anticipating 38% upside with their price target of 920, is this sufficient for you to consider in your portfolio? As always, give us your thoughts about Qualcomm, Lam Research and ASML, whether you are adding to any of these or maybe just holding for the time being, or in fact also considering a semiconductor ETF just for that exposure right across the industry. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are notified as these videos drop. Don't forget to sign up to the free weekly newsletter below and click on the pinned comment where you can join the Patreon where we discuss our weekly buys and sells. As always, have a great day and we'll see you all on the next one.